Welcome to this Gold Money video. I'm James Turk. With me today are two of my Gold Money colleagues, Alistair MacLeod, who's head of Gold Money Research, and John Butler, who's head of Gold Money Wealth Services. What we're going to be doing this afternoon is talking about the year ahead, 2016, what lies ahead, and what it may impact on gold and individual portfolios. So I'd like to start first with Alistair. Alistair, how do you see 2016 unfolding?
I think this is one of the most interesting years that I have ever seen. If I can just recap slightly. 2015, we saw the rest of the world, apart from America that is, which I'll come to in a moment, if you like, entering a recession. You have a credit bubble in China which was deflating, and it was affecting all the commodity prices. And the result is that global trade has actually taken a very, very bad knock. So in 2015, we were entering 2016 with that as a background. Meanwhile, in December, the Fed raises interest rates, only by 0.25%, but with an intention to continue to raise rates gradually through 2016. Now, here we are less than a month since that event, and already it's beginning to look like a misjudgment on the part of the Fed. And I don't think I have seen so many major mainstream investment banks really worried about the prospects of 2016. And certainly from a banking point of view, if you think about all the bad debts that have accumulated and are accumulating in the commodity sphere, as a banker, I think you would have cause for concern. On top of that, we have got the European Union. The Eurozone in particular has got some major banks with very, very slender levels of capital. I mean, typically, I've calculated that the average level of bank capital in the Eurozone equates to 1/24th of their liabilities, including off-balance sheet liabilities, I will admit. But that level of balance sheet gearing for banks going into what appears to be a global recession, I think is a very, very dangerous situation. So I'm not surprised that the major banks, the major investment banks, who do have their fingers on the pulse, particularly of the over-the-counter derivatives and so on and so forth, are expressing concerns about the outlook. On top of that, equity markets in particular are, by any metric, very overvalued. And so we've got the prospect for assets to decline in the first half of 2016 as these shocks begin to work their way through. So in short, I think the outlook is very, very concerning. I think we could be seeing the Fed reversing its interest rate policy. And here is an outlier in terms of forecasts. I would not rule out the prospect of negative interest rates for the dollar. Now, that's a major, major statement because it immediately puts all commodity markets into immediate backwardation. And if you want to stabilize commodity prices, I can think of no more effective or rapid way of doing it. So I think 2016 is going to be a very interesting year and a difficult one to survive intact from a financial point of view, unless you're very nimble.
Okay. John, how do you see 2016 unfolding?
Well, I share essentially all of Alistair's concerns. I may look at certain things slightly differently, and I'll emphasize that for a moment. I mean, for example, I think that the commodity angle and the carnage that's been occurring in commodity markets is extremely important, but for a variety of reasons. One of which, of course, is that it really is the pulse of the global economy. And the fact is, you cannot explain away not just the decline in oil prices, but of industrial commodities generally, metals and other industrial products. You can't explain that away as a supply shock, as a supply side phenomenon. This is real-time evidence that there has been arguably a collapse in global industrial demand. Services may still be holding up, but history shows you that that sort of decoupling is almost always temporary in nature. What's concerning to me, though, goes beyond that, and it has to do with the systemic linkages in the international financial system. Alistair briefly touched on this, that is the concern that certain major commodity firms may actually end up defaulting at some point in 2016. Well, that's actually begun. A subsidiary of Glencore, a U.S. aluminum subsidiary of Glencore, actually defaulted this week. And so this is going to be something that's going to play out in the coming months as more and more cracks in the commodity sphere become evident. The problem is this: policymakers, I believe, and financial markets still operate from this idea that the commodities carnage can be contained. In the same way, back in 2007, we heard people talking about how subprime could be contained. Oh, it's only a small percentage of the market. Economics 101 tells you that prices are set at the margin. And when it comes to financial assets, that means perceptions of risk at the margin are setting those prices. You can't easily contain something like that. The price is set at the margin. It's the distressed manufacturer, the distressed firm, that sets the price of risk, and that can then spread into other areas that are not at the time distressed. It affects liquidity conditions, and that can reach into the heart of the banking system via the shadow banking system. One problem is this: there's a lot of bad collateral out there. There's a lot of debt, junk debt, that has been overvalued and is going to have to be written down. The problem is this: how have the money center banks made profits in recent years? Largely through so-called collateral transformation, where they lend against bad collateral, they lend good collateral to allow weaker banks to prop up their capital ratios. This is very difficult to account for under current accounting standards. What it means is that all the money center banks providing this liquidity for collateral transformation, they've systematized what was otherwise more idiosyncratic dispersed risk. They've concentrated it at the center of the system. I don't believe, therefore, you can contain what's happening in the commodities markets. It will eventually spill over. We're going to have some sort of financial crisis before the end of the year. I just can't predict precisely where, when, or how it erupts.
Yeah, it sure feels like it. Alistair was talking about negative interest rates possibly for the dollar, and Alistair, I guess by implication, you're seeing continuing negative interest rates by the ECB and some of the parallel countries that have tied their currencies to the ECB, like Denmark. And I think Sweden now is in negative interest rates as well. How do you see interest rates unfolding in the year ahead? Are you pretty much on stream with Alistair's view?
I do agree with Alistair that 2016 will also be a year in which we see fresh expressions of unconventional monetary policy, whether it shows up first in the euro area, in various emerging markets, the United States, I don't know. But I think it's highly likely, given the apparent strength of this global downturn, that one or more central banks will move back in this direction of unconventional monetary policy and possibly something entirely new. It could be a further extension of negative interest rates. It might look somewhat different. I mean, I honestly don't know what rabbit they might try to pull out of their hat next. However, this is where I believe you're really even further into uncharted waters, because the whole concept of negative interest rates is one that it's not linear in the way that when you lower interest rates from 2% to 1%, it's kind of a linear event in terms of its effect on borrowing costs and the way the economy and financial system function. But when you go from positive to negative, and by negative I mean negative enough that it really becomes an alternative for people to dramatically change their behavior, I believe you're going to see unintended consequences, and you're going to see unintended consequences showing up sooner rather than later, and policymakers may be surprised by those. They could be quite negative, and in fact, even the New York Federal Reserve has done some conceptual and theoretical work on the possible unintended consequences of negative interest rates, and some of them actually might accelerate a flight of deposits from the banking system and a disintermediation of the banking system as people seek ways to avoid those negative rates. Alistair mentioned the backwardation in commodities markets. You can earn a positive roll yield from backwardation in commodities markets, and that's precisely what negative interest rates might cause.
Yeah, so in essence, negative interest rates could have a perverse effect.
Yes.
And impair even currencies and cause problems with people holding currencies
Indeed.
and looking for alternative assets. In that environment, though, Alistair, maybe stock markets could conceivably go higher because it's better to own a tangible asset or a near tangible in the form of, say, a commodity producing company and not have money on deposit in a bank. You see that as a potential unintended consequence?
Well, I have no doubt that negative interest rates would be supportive of asset prices generally because of what you mentioned, and that is people trying to get out of deposits and getting into something which isn't going to tax them in effect, because that's what a negative interest rate is, it's a tax. But there is another element to all this which I think is very, very worrying. If we get instability, financial instability from the unintended consequences of interest rate policy, then just bear in mind that the Eurozone's government debt, the quality bonds, if you like, in the Eurozone, are by any measure wildly overvalued. I mean, we've got Greece last year. Greece is going to come back again this year. We have got Spain, which is 10 times the size of Greece. We have got Portugal, which is the same size of Greece. They're all moving towards doing away with this austerity. I think that there are huge, if you like, waterfalls and rapids to overcome in the government bond markets in the Eurozone. And that, again, I think is going to throw up problems worldwide. In order to stop this becoming a systemic crisis, I think that another feature that we will see in 2016 is that the major central banks will be working more and more closely together to handle what could turn out, if they don't stop it, turn out to be a global crisis.
I think we all agree that, in 2008, they didn't really solve anything. And all they did is, as the saying goes, kick the can down the road. But the can is no longer a can. It, to me, looks like a 2-ton boulder, and it can't really be kicked any further. Would you agree with that? And that we're really going to face in 2016 is maybe some kind of credit crisis issue in terms of how much more debt they can put onto this over-leveraged system?
I would agree with that entirely, and I would actually take it one step further. I think the experience of the central bankers over the 2008 crisis will encourage them to debase their money more rapidly than they did then. I think that they're likely to become more Keynesian as a result of a developing crisis than they were at that time. Because, as far as they're concerned, the inflationary consequences never really materialized. So I can see that, it's the only thing they can do, really, and that is to flood the system with money, to write blank checks for the banking system, in effect, to try and keep it afloat. That's what they did in 2008. In 2016, the size of those blank checks is bound to be considerably larger.
Yeah. When you're debasing currency, obviously people would naturally think that, well, I want to go into things. I want to go into tangibles. I want to go into gold. I want to go into other commodities. But here we have it's a paradox. The central banks over the past year have been debasing their currencies. The Federal Reserve maybe not, because the Federal Reserve balance sheet is unchanged from year to year. So maybe the dollar has held its own. But all of the other currencies of the world are being debased by various quantitative easing programs, yet commodities have tanked. And obviously, as you were saying, John, it's got to be to a certain extent because of a collapse in industrial production. We see that by the Baltic Shipping Index, which is near all-time lows, meaning goods and services just aren't being traded because there's no economic activity. But doesn't it seem like a paradox? Debased currencies has resulted in lower commodities?
Well, there's
Alistair first?
Yeah, please.
Okay. I think that most people only think in terms of the commodity price when they see that copper is 200 cents a pound or whatever the figure is. But the other side of it is what's happening to the currency. And a lot of the weakness that we have seen in currencies has come from the dollar side rather than the commodities themselves. Now, what this tells me is that...
In other words, pricing things in dollars, things look cheap, but if you're pricing things in terms of euros and Russian rubles and Brazilian reals, it looks very, very expensive.
Not so cheap, or even more expensive. Because the currency itself isn't static in terms of what it will buy, and you're likely to get shifts of preference. Now, at the moment, the shift of preference is from people who have got obligations in dollars and they need to acquire dollars to discharge those obligations. And the banks are leaning on them and saying, sorry, we're not rolling this one over, we want our money back. So that, I think, explains a lot of the strength we've seen in the dollar, and therefore a lot of the weakness in the things that are priced in the dollar, and particularly commodities. Mm-hmm. Now, at some stage, I think there is a danger in 2016 that will start switching round. And if it switches round, what you will see is a change in preference, if you like, working against people holding dollars And this, after all, is what we're talking about with asset prices rising. Rather than hold on to dollars because you've got negative interest rates or back to zero interest rates or whatever, you would rather have something tangible. And that basically means that your preference, if you like, for holding dollars is eroded.
Yeah.
Now, this is a very, very, it can be a very volatile situation, because this isn't just a case of new money being printed, entering the economy, and prices gradually rising to absorb that new quantity of money. It's not that. What we're talking about is a loss of confidence in the currency. And it doesn't take very much, and it is very hard to predict if this is going to happen or when it will happen. But it doesn't take very much to completely undermine all confidence in the currency, and suddenly you find that all you have got are bits of paper.
Yeah.
And that is the big danger.
So to interpret what you're saying, that commodity prices in terms of the currencies other than the dollar will continue to go up as they have over the past year, and commodity prices in dollars, though, will now also start going up. In other words, you're calling basically a low in commodity prices.
Yes, I think once this rush, this rush to cover dollar obligations, once that abates, I think the purchasing power of the dollar will start abating as well, because that, as far as I can see, is the only thing holding the dollar up.
Yeah, I want to come back to the demand for the dollar, but before I do that, I just want to go to John on this point I was making about the paradox of debasement of the currencies and what's happening with commodity prices. Alistair's made a good point that it only looks like commodity prices are going down when you measure it in dollar terms. Just about all of the other currencies, commodity prices go up. Is there anything you'd like to add to that?
Just to emphasize, the dollar really is the outlier here. It really is. That is, all the commodity weakness that we see is actually currency weakness vis-a-vis the dollar as well. It is a combination of both. The dollar is the outlier. If you just plot a range of prices, various other currencies, non-dollar currencies, including, of course, emerging market currencies, some of which have collapsed in value, and you plot those alongside the commodity prices, you stand back from the chart and you see it's the dollar index itself, which is the real outlier here. And as Alistair has pointed out, this is because a lot of the people that borrowed in the boom phase post-2008, 2009, the artificial boom, as it were, that was created by the flood of stimulus, both physical and monetary, that boom has turned to bust. Those obligations are now being called in, they're being discharged, or people are attempting to do so. But there is simply not enough liquidity out there, not enough dollar liquidity out there to allow that to happen. Why? Because the real economic value added, the true ability to generate a sustainable income, was never achieved because of the artificial nature of that boom. So the developed economies never fully recovered. They've just sort of flatlined since 2009, within small little cycles here and there. But the BRICS and some of the other emerging markets, they've had a big boom, and now they're having a big bust. So this flat cycle down here is being met by this bust cycle from above, and they're going to reinforce each other to the downside. Where's the marginal demand going to come from? Which country is still in a position to stimulate its economy to provide that demand for the rest of the world? There's no one left now. And therefore, the dollar looks okay for the moment because U.S. services and the U.S. consumer are holding up. But history shows you that this is not containable. Eventually, that will also join into this downturn, and then the Fed will respond. Then the Fed will respond. They will blink. They might reverse their rate hike. They might introduce QE, whatever variant thereof. And that's when the dollar finally gets hit, because everyone's already losing faith in other fiat currencies, and they're rushing into the dollar. But if they begin to lose the faith in the dollar, you can't rush back into those other currencies. You've already lost faith in them. You must go to tangibles at that point. You have no other choice. And that, I believe, will be a dynamic that does establish itself before the end of this year.
Okay. I'd like to go back to this demand for the dollar. I like to always emphasize this point because it's generally overlooked. But we talk about the supply of money, M1, M2, M3, but very rarely do we actually talk about the demand for money. But money is just like any other good or service. It has a supply and demand. And when you're talking about prices, you have four forces coming into effect. You have the supply and demand of the item that you're looking in terms of the price, and then you have the currency that you're using to price that item. So you have the supply and demand in the currency, and you have the supply and demand of the commodity that are interacting in order to come up with some commodity price. Now, Alistair, you're saying that we could see a demand for the dollar decline in the year ahead, which is the opposite of what's been happening over the past year. People see QE in Japan, they see QE here in Europe. as you mentioned, the problems here in the United Kingdom where we're speaking. And as a knee-jerk emotional reaction, they sell the yen, they sell the euro, they sell the pound, and they go into the dollar. So the dollar has benefited from that. What you're suggesting now is that trade, which has prevailed for the past year or so, could now unravel, regardless whether the Federal Reserve changes its policies or not?
Yes, I think that's right. And there is another element which nobody, to my mind, is actually thinking about. And that is, since 1985, the banks have progressively taken over the management, the ownership, the running of securities markets. So they've been using their bank credit and refocusing that towards promoting over-the-counter derivatives, which got up to 710 trillion at one stage. It's now backed off from there a bit. Pushing up securities markets, pushing up government bonds because they need it as collateral, and so on and so forth. Now, that is something that is on the decline. Now, as that declines, the demand for dollars is likely to drop from the financial sector. So that, again, I think could actually have a major impact on the value of the dollar in this coming year. And as well as that, there is also, if I can introduce it very briefly, a geopolitical aspect, and that is that China has moved away as much as it can from the dollar. That's a process that will continue. And there is little doubt in my mind that the Chinese currency will be the currency of preferred trade throughout Asia. And that's where China is trying to get to. So all those dollars that are held abroad for various reasons, whether it's commodity loans or whatever, or they'll actually buy something on the streets in Venezuela. All those reasons, I think, are declining, and therefore you're likely to have dollars coming back. And interestingly, this was exactly the condition that we had in the 1960s, when central banks responded to that by sending their dollars back to New York and saying to the Fed, we want to buy gold with it. So we are, in a sense, I think, in a similar point, if you like, in the cycle of repetition that makes up economic history.
Well, you're definitely seeing it with certain central banks, particularly the Asian central banks, which have been accumulating their gold reserves. And now central banks have become net buyers of gold in recent years. Just in terms of your point about markets, stock markets being overvalued, I've always found it difficult to measure an overvalued stock market when you're dealing with an overvalued currency, which the dollar is at the moment. So again, just to go back to that point, stocks could go higher if the dollar goes lower, and maybe get back to a more normal level. I guess what I always like to do is I like to look at stocks in terms of gold. And right now, the ratio is still in favor of avoiding general stock market indices and owning gold. But of course, the stock market is not a stock market, it's a market of stocks, and there are certain sectors within the stock market that could do well in the years ahead.
There is another element to that. You're absolutely right, I think, to look at it in terms of what gold will purchase, if you like, in the stock market. Unconventional though that approach may be, I think it's going to get less unconventional in time. But there is the aspect of how the Fed responds to a weakening dollar, because the Fed targets not only unemployment, but it also targets inflation. And if the dollar weakens significantly, the Fed is going to have to raise interest rates, even though there may be, as I suggest, a temporary period where they either consider or actually go for negative interest rates. The result of that will be that the upcycle in interest rates will start, and it will be more vicious as a result. Yeah. And that is something the stock market does not like.
What if the Fed does something out of the ordinary, like impose capital controls? In other words, dollars that are outside the United States can't be sent back to the United States. Then it doesn't have to raise interest rates. The international dollar will fall to a steep discount to the domestic dollar because you can't really spend it back in the States. What do you think about an outlier like that as a possibility, John?
But in a way, that then becomes a self-fulfilling prophecy. If you close the door on free dollar convertibility internationally, you are basically accepting that the dollar has lost reserve status and the benefit that comes from having that going forward. It will impose a rationalization on U.S. finances because you will no longer be able to finance deficits abroad. And so, don't get me wrong, in desperation, they might try to do so. It's not dissimilar from what Nixon did by closing the gold window back in 1971, but it's a one-off. You're saying, okay, we want to relieve ourselves of the burden of past excess, but that will then force you going forward to not try to finance further excess because it will be prohibitive. And so you will no longer be able to run chronic deficits. And how on earth is the United States government going to fulfill its current obligations?
I want to get to the deficits in a second.
Sorry.
But just to follow on this, in my lifetime, my 45 years of dealing with markets and economies, we've moved from what we had before to what we have now. We're moving ever closer, at least in the Western world, to what I call command economies. We have the Politburo sitting in the Federal Reserve determining interest rates. Interest rates are the most fundamental thing in a free market economy. So why couldn't they just go further in this command economy scenario and impose capital controls?
Oh, don't get me wrong. I mean, there's a certain pathology in the way they've been behaving in recent years. Even before 2008, you could argue that central bankers were, with every boom-bust cycle, they were going even farther in the degree of their interventions. And of course, the unconventional has now become the norm post-2008. So no, as per Hayek's road to serfdom, it could be that they're going to carry us back to some sort of anti-market, command economy, almost medieval world in which all the benefits of a tremendous division of labor and capital across the world are going to go into reverse, globalization in reverse. And that's a net stagflation for everybody. It implies weaker growth, it implies higher prices, and it would be disastrous for the entire global economy. Sadly, though, that is currently the course we are on. And one would hope that they'll come to a realization that moving towards a command economy, shutting down markets, heavy-handed movements like imposing capital controls, trade barriers would follow from that most probably, that these things will be as bad or worse as what happened in the 1930s. And we know how that played out, and we really don't want that sort of history to repeat here.
Yeah.
I think there is another, so if I can just add
Sure.
to what John is saying, there is another aspect to this. And that is, in the 1960s, we had the Bretton Woods Agreement, and in 1971 it fell apart. There was no competitor to the US dollar as a reserve currency replacing gold. Nowadays we have got the Chinese yuan, and I think that's a very different thing because China is building her currency to replace the dollar, certainly throughout Asia, and also with her preferred trading partners, who basically are the BRICS, the countries with resources to export to China. So I think the decline of the dollar, whether or not they introduce capital controls, is going to happen. And I think if they introduce capital controls, it could actually happen a lot more rapidly. I think it would be a very, very bad step for them to take.
That's a good point. Also in the 1960s, you had a bipolar world with the Cold War, and people wanted to be under the American nuclear umbrella. That's really no longer an issue in today's environment. So again, that ultimately decreases the demand for the dollar. But which actually brings me to one of the themes we can be looking for 2016, which really isn't a shocker because it's been ongoing for many, many decades actually, is debasement of currencies as governments impose more and more controls, interventions, manipulations in terms of various key components of the economy, be it interest rates or if they take a drastic measure like capital controls. Would you agree with that? John?
Look, I mean, what we've seen, what history demonstrates, is older history as well as contemporary history, is that you simply cannot underestimate the risks that these people are willing to take to see if they can try to get anything to work. It's almost a sort of flailing policy response. Shotgun, throw darts at a dartboard, throw mud at the wall, something will stick. And I do believe it's very, very difficult in that sort of environment to predict what will happen. You need to think more with an insurance-type mentality that almost anything becomes possible. And financial repression can take many, many different forms. And you've got to think in terms of, okay, if we need to take an insurance approach against simply not knowing precisely what form various actions may or may not take, what is it that we can do? Try to think as positively as you can. Try to be as proactive as you can. So, I mean, all of the things we're discussing, yes, they would be economically damaging, some more damaging than others. But in terms of where they're going to show up, exactly what effect they're going to have, it's impossible to know exactly. You've got to adopt a more insurance-type mentality when it comes to investing.
Look, I want to wrap up with solutions in a minute, or possible ideas that people can take with them and think about. But before I do that, I just want to talk about government finances. The U.S. government debt now is approaching $19 trillion. And one of the benefits of negative or low interest rates or the zero interest rate policy, it reduces the U.S. government's debt burden. It's essentially paying zero on Treasury bills as opposed to a fair rate of interest, which might be 5 or 6%. So as a consequence, the annual debt burden is a lot less than it would have been in the 1990s, where you're paying a much higher interest rate, an interest rate above the inflation rate. Just generally, what are your views, John first and then Alistair, on government finances looking the year ahead? And not just the US, but just generally globally, because it seems to me that governments everywhere are still spending too much money.
Oh, for sure. And tax revenues are naturally correlated to the economic cycle. That said, they tend to be correlated with a lag. And certain types of tax revenues have a longer lag than others. The United States government has relied excessively on capital gains taxes through some of the boom-bust cycles of recent years, because the income tax take has not increased to the same degree that asset prices have risen. And that's very important. If you get into an asset bust as well as a general economic downturn, something that I think we agree is probably unfolding this year to some extent, then the impact looking forward for tax revenues is very negative indeed. And it makes it that much more important that not just the United States, but all of these countries that are over-indebted, that they keep interest rates low. It will keep things going, from their perspective, it will keep things going a little bit longer. It will postpone the day of reckoning, as it were. But the problem is this: the productivity of private debt tends to be much higher than the productivity of public debt. Private debt is incurred by an entity that knows that if it does not achieve a certain rate of return, it will not be able to service that debt. It will go bankrupt. The same is not true of the public sector. They simply believe that by incurring debt, they're buying time for whatever policy plans they have down the road, and they don't really care about the long run. In the long run, they're all dead, Keynesian type of mentality. So the marginal productivity of public debt is very low. So private debt still commands a reasonable interest rate. You still have to service the credit spread on your debt, and you need to rationalize what you're doing as a firm to some extent, even in a low rate environment. Governments don't need to do that, and therefore all we're doing is prolonging a huge misallocation of resources away from the private sector towards the public sector instead, and it's only lowering our potential growth rate going forward.
But are we near the end of that model, do you feel, or could it still go on for years? I keep saying that it all comes down to cash flow, and with interest rates so low, it's enabled governments to perpetuate that a little bit longer. But can they still go longer before that public sector debt?
To Alistair's point, it may have to be resolved at the international level. You may simply need the foreign creditors, the big savers in the world, including China, but also a number of other countries. They may simply have to say enough. They may simply have to say, we are not going to play this game anymore. We're not going to keep supporting the over-indebted economies. We've got to get past this somehow. And someone becomes a first mover, and then you destabilize the equilibrium, and you get into sort of a game theoretic tipping point, nonlinear dynamic, and all of a sudden the equilibrium shifts. Exactly what form that takes and what timing it will take, I honestly don't know. It could be this year. I honestly don't know.
Yeah, none of us honestly know, but I've had to ask you that question anyway, just to see what you were thinking about it, because it's something I've been thinking about all of the time. When is it finally going to happen? Because it seems unsustainable that it can go on forever. It's just a question of timing. Alistair, what are your thoughts on sovereign debt?
If I can answer the question you posed, I think that there are two things I'd like to say. First of all, low interest rates did not discourage governments from increasing borrowing. If anything, it encouraged them. So the result is that the level of government debt in the system has actually increased exponentially. And as long as interest rates are low, they're going to continue to increase exponentially. The second thing I'd like to say is that if you're a private company and you submit your accounts for audit, you have to show the net present value of future liabilities that you as a company face. Government does not do that. If they included the net present liabilities of the health services, the pensions and all the rest of it, and it's escalating, it's completely out of control. So we have a situation which by definition cannot last very much longer. And I see very, very little. There's a bit of an attempt in the UK to address this problem, but I see very, very little attempt to address this fundamental problem, particularly in Europe. You look at France, you look at Italy, you look at Spain. Not only have their government finances deteriorated very substantially since 2008, but there's off-balance sheet deterioration as well, which actually we should be really worried about.
Yeah, I've seen estimates for the U.S., for example, that it's well over 100 trillion of total liabilities that it's on the hook for, at least what it's promised to be on the hook.
has done that
research. Yeah, exactly. They did the research, and against 19 trillion, which is commonly quoted as the public debt or the national debt. So I mean, the off-balance sheet numbers are just totally mind-boggling. But Alistair, in that environment, doesn't that mean, just looking back at history, that ultimately the currency is going to be killed because they will fulfill the promises by paying an ever worthless currency?
Well, we're seeing the seeds of currency destruction actually happening now. And this is one reason why I emphasize the geopolitical aspect of this. With China becoming very much a world economic power, and India as well, things are moving away from the old-fashioned welfare warfare states. And as a result, they're bound to be very substantially weakened, not only in 2016, but after that, if we survive with the system as it is for very much longer. So I think there are huge, great challenges to meet, and the politicians naturally don't want to even face it. But I think they're going to have to, and that's going to be another interesting feature.
Yeah. Let's start to wrap up with some general solutions that people can think about. And let me go first with this and see whether you guys agree with this or not. But my view has been that since 2000, we've been in a financial bust. And I use a number of different measures to actually show this, one of which is I like to look at stock market averages and measure it in terms of gold. And the Dow Jones, for example, was 40 ounces of gold to buy the Dow Jones Industrials back in 2000. And at the low points, it's usually about an ounce of gold to buy the Dow. So, for example, in the 1930s, the Dow was 35. After the devaluation, an ounce of gold was 35. In 1980, which is very much in my memory and yours as well, and the Dow was 800 and an ounce of gold was 800. So at some point in time in the future, I think the Dow is going to be 1 ounce of gold again. Obviously, what that 1 ounce of gold is going to be depends on what the Federal Reserve does. Are they going to hyperinflate the dollar, or are we going to go into a massive deflation? Only time will tell. But that general view means is that when you have these boom and bust cycles, during a boom, you want to be in financial assets. During the bust, you want safety, security. You want to be essentially in tangible assets. So my view has been that since 2000, you want to be moving out of financial assets and focusing more on tangible assets, own things rather than promises. And I think this theme still applies in 2016. Would you guys agree with that? John, do you want to go first?
I mean, I would agree with that. And I think that looking at relative values is the single most important thing investors have to do, because if you live in a world where currencies are themselves a moving target, what's your benchmark? It's difficult to know whether your stock market is truly growing your purchasing power if the currency of denomination is losing purchasing power. And so gold becomes extremely important as a universal point of reference, not just for thinking that the gold itself can preserve purchasing power, but for benchmarking the returns of other assets. And if you do look at the relative valuation of precious metals to stock markets today, the gap is very, very large. It does suggest that stock markets, in particular in the United States, to a lesser extent elsewhere in the world, are overvalued. But as you say, if it's going to come to an inflation, or perhaps even a hyperinflation, there's nothing to stop stock markets going up. But in relative terms, in that sort of environment where by definition resources are being horribly misallocated, gold should outperform. What is a stock? What is a company? It is something that lies between raw input on one side and output on the other. It's a bunch of productive, efficient processes. The valuation on those processes should only rise sustainably if truly sensible investments in the future are taking place. They're not currently taking place, and therefore, looking forward, we should see a general re-rating of precious metals and a general derating of stock market valuations. But yes, it could be that all prices rise if it comes to a general inflation.
Even a hyperinflation, which we have to consider as
a
possibility. Just to go on one of the points you were making about gold and its role, then an ounce of gold or a gram of gold becomes the measuring stick, just like a quart becomes a measuring stick for milk, or
That's right.
A yard becomes a measuring stick for cloth. And what you're actually doing with that gram is you're actually measuring wealth you're measuring financial assets, and you're measuring, how you're going to employ capital and what the return is on that capital. So in your view, gold still obviously has a key role to play as a measuring stick, which ties into the point we were discussing about gold being a standard.
Yes, absolutely. And indeed, I would go so far as to say in the world we currently inhabit, where currency values are simply indeterminable because of the pure uncertainty of what policymakers will or will not get up to next, you should actually place gold at the center of an investment process, not just as a savings vehicle, not just as a form of financial insurance, but actually as the core asset around which you diversify. Most people do that in terms of cash. They think, okay, I need this much cash and I can take this much risk in equities, this much risk in stocks. Here's my diversified portfolio. But their currency, their local currency, is their benchmark for constructing that portfolio. I suggest placing gold at the center of the investment universe, where it belongs. And in the same way, by Newton and others placing the sun at the center of the solar system, they were able to finally understand gravitation. You place gold at the center of your investment process, you can finally understand better the world we truly live in, the risks we are truly taking, and how to extract truly meaningful diversification from a portfolio of financial assets.
So gold becomes the bedrock asset in one's portfolio, and it's also the means of economic calculation.
Absolutely.
In other words, the way to measure the prices of everything else.
That's right.
Alistair, getting back to my point about 2016 being one in which you want to focus on exiting financial assets and concentrating more on tangible assets in terms of relative valuations, financial assets being overvalued, tangible assets being undervalued. What would your thoughts be on that?
Well, my thoughts, it is a very difficult one because the starting point, I think, is to look at what money actually is. And money basically is your stored labor. I mean, we go and we work for a living and we are paid money, and we will accept that money on the basis we can then exchange that money for the goods that we actually want.
Goods or investments?
So, well, investments are meant to be, they sort of replace savings, as it were.
Well, it's a third level. Goods, savings, investments.
And investments, absolutely. It's that third level which has been pumped up hugely, really almost directly as a policy of the central banks. I think it was Alan Greenspan who 10 years ago said things like, if you have a good stock market, you get confidence in the economy. And I think that has been the mantra in the Fed ever since, and incidentally, I think in all the other central banks as well.
Yeah.
So when that comes to an end, obviously you don't want to be holding investments anymore, and I think we've already discussed that. But it is an interesting thing. I mean, at the moment, interest rates are very, very low. And what you can do is you can deposit some money with a building society. You can then gear up on a mortgage, let's say at a fixed rate for 5 years. You probably pay something like 3% in sterling. Now, your gamble, if you rent this property out, is twofold. Firstly, that you're going to continue to get rent from whoever you let it to. But the other principal gamble that you're going to get, apart from that yield, is that the value of the property will tend to reflect the other side of the devaluation of the currency, the fall in the purchasing power of the currency.
It's almost like a natural hedge in that sense.
Yeah, and so that's a good example of a real asset. I mean, typically in the West Country where I live, you can buy a property which will give you a yield, if you gear it up, say 3 or 4 times, something in the order of 11 or 12%. Now that's very, very nice. Of course, there's no guarantee that somebody's going to pay rent over the period. And the government here, God bless them, are trying to discourage this sort of investment because they're worried about money supply and overheating the market and all this sort of thing. But the fact of the matter is that since the 70s, certainly probably a bit earlier than that, since the late 60s, property has been the bedrock of everybody's savings in this country. And I would take comfort in this thought, and that is the one thing the government will not do is actually destroy the property market, because otherwise it destroys its electorate.
Yeah.
So there is safety in numbers in that sense. But I think we have to make this distinction, which you just pointed out, that one is a real tangible asset, and the other, investments like shares in a company or whatever are not. They are liable to unexpected risks. I mean, we've talked about in the past, I know, when we've talked about these things between us, the problems in the futures markets. What happens if there is a general disruption in the market, like people fail to settle? I mean, this is a continuing debate when it comes to gold futures. force majeure, and then you're sitting there with a contract thinking it's representing ownership of however many ounces of gold, and they turn around and say, sorry, we're scrubbing it, Thank you very much. I don't think this is actually what one went into it for. So financial assets do actually have huge, huge risks, which are buried most of the time. And nobody actually wants to talk about it because it's in nobody's interest to talk about it.
Yeah.
So I would take up your point and say you must distinguish between what is an investment, and I put that in inverted commas, speculation is probably a better word, and a tangible asset.
Okay, great. I'd like to wrap up with just parting comments. John, first, if there's anything you'd like to stress that you see as important that we haven't already covered looking out for the year ahead?
Well, I think we've covered a lot of ground. I mean, I would simply say that anyone who's looking at 2016 really needs to be looking at history. Yes, a lot of what's happening appears to be unprecedented, but you'd be amazed the examples that you can find in history that provide at least some guidance for what is likely to unfold over the course of this year. And it's not necessarily very pretty, but it does mean that investors should think, again, about insurance, about true diversification. And that's why unencumbered precious metals are such a great source of both insurance and diversification, because you can't default on them. Financial assets may be correlated to the prices of precious metals. Inflation prices go up, deflation prices go down. But sources of credit risk, they can ultimately default. The risk ultimately becomes binary in a default event, whereas the prices of precious metals will move in a more linear fashion as the risks shift back and forth between inflation and deflation. That is true qualitative diversification. It's true insurance. And it does mean that investors who, don't get me wrong, should be looking for value in stocks and bonds always. Why not look for value in stocks and bonds where you can find it, or property? Should be holding more pure insurance, that is precious metals, within their portfolios currently than at any time, or probably in the investing lifetime of anyone who is still alive and investing today.
Particularly because the metals are so undervalued here?
It's not just a value call. Think about it.
It's a strategic
How do you value an insurance
portfolio
policy?
call.
How do you value an insurance policy? You value it based on what you think the value of your home is. If you're going to insure your home against fire, you pretty much just pay the going rate for that insurance. Yeah. But of course, if you think for whatever reason a fire has become even more likely, such as with the financial markets today and the risks in those markets, you buy commensurately more insurance. You don't buy more insurance because the insurance is cheap necessarily. You buy it because the perceived risks to your property are greater. And that, I think people should adopt that sort of mentality when thinking about precious metals today.
Yeah, it's strategic in a sense as well. It's a big picture macro view as to where we are today in the world and what's likely to unfold, or what we think could unfold in the year ahead. Or put it this way, the risks that we have to guard against, just in case they do unfold, we want to be ready for them.
Absolutely.
Okay. Alistair, do you have anything that you would like to add as what people should be looking for in 2016 that we
have covered a lot of ground, James, but I think there are two things I'd like to say, and they're both about the value of money. I think that it's very important for anyone who really wants to try and understand what's happening to understand that the purchasing power of money goes up and down on its own accord. And so prices reflect that, they include that. And if confidence disappears from one currency, its purchasing power goes down. You don't need to have an explosion in the quantity of money or credit in order to undermine the currency. It's just what all of us think collectively. If we turn around and think, I don't like it, I'm going to dump it. Whether you dump it for another currency or whether you dump it for real goods of some sort is immaterial. It does affect the value of the currency. And taking a leaf out of your book saying history, I'd like to leave one thought. In the 13th century, Kublai Khan got all his merchants in China to submit, on pain of torture or death or whatever, their gold and silver, in exchange for which he gave them paper printed on mulberry leaves. Now, gold is still there, silver's still there, the mulberry leaves ain't.
That's a good story to end on. John Butler, Alistair MacLeod, it's been a great pleasure talking to you about the year ahead. I'm James Turk. Ladies and gentlemen, thank you for watching this Gold Money video.